For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance.
Jay Powell there, stressing that the Fed is in no rush to cut interest rates. Good morning. You're watching The China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks trading with caution as Powell's wait-and-see approach dashes hopes of a so-called Fed put amid the trade war.
Now, China is suggesting it is open to trade talks if Trump shows more respect, while the president touts big progress in negotiations with Japan. Washington seeking to box in Beijing in tariff negotiations with other countries.
Plus, we hear exclusively from the Xpeng CEO as the EV maker ramps up global expansion despite the tariff war. Well, central banks are really one of the guiding matters for markets this morning, but essentially very much focused on what we've been hearing from Jay Powell. We can also just kick off with the BOK, because we just had that decision coming out, largely expected by economists in our survey, but keeping their key rate at 2.75%. You can see the cost be there. We're also, of course, watching what's happening with the Korean won. But as you said there, Dave, really at the top, it is that big focus on Jay Powell and what exactly he signaled around this focus on inflation versus growth. And right now, it does seem like they're more focused on anchoring those longer-term inflation expectations, less concerned about the recessionary backdrop or that risk that we see recession in the future, and cutting rates to safeguard or against that. So essentially in the session today, that's going to be a really big focus, also tracking, of course, what's happening with the dollar. You're seeing it just a little bit firmer here this morning, and also this expectation around earnings, because TSMC is going to be very, very closely watched later today as well, specifically what they guide around the outlook, because yesterday it was definitely that story around ASML, for instance, Nvidia as well, casting a lot of caution over traders. So let's take a look as well. Golden Dragon Index. One of the things that we're seeing today is really this traders reacting to trade negotiations. Japan has been a really big focus, and we're seeing some signs of progress there. Yesterday as well, we had a Bloomberg scoop out in late afternoon, essentially opening the door to some sort of negotiations with the US from Beijing, but certainly putting some conditions in place in terms of what they want to see. Point person, for instance, also the types of language or the way that the Beijing expects to be treated in this didn't really play out in the Golden Dragon Index, still under pressure. And again, you're setting up for the session today, Dave, in the red.
Yeah, and we'll likely get, as things stand, and in fact, we're already there on the Hang Seng China Index, a little bit more going there in the Hang Seng Index. 6 weeks of losses across the benchmarks. Of course, if you take sort of a look on a daily basis, it doesn't seem like we are on track for 6 weeks, but you had, of course, that massive drop on Monday, which effectively offset most of the gains that we have seen of late. So those are the specific levels we're watching on both. If we close below that today, and just to mention, it's Thursday, yes, but we are entering a long weekend. That would be 6 weeks of losses on both, and certainly going into a long weekend where anything could happen, certainly the incentive might be oriented towards reducing your risk than otherwise. Right. A couple of stocks that we're tracking here. See, Kingsoft Cloud, Meituan. Kingsoft fell about 16%, double digits yesterday. Meituan fell the most. Among the most in Hong Kong yesterday. So a couple of stocks that we're tracking going into today. Bell talked about TSMC and chips, and gold continues to remain bid. Speaking of data, so we are in the window still for FDI numbers coming through. We did just get the SWIFT payment numbers, which is normally a data point that we don't normally talk about at length. But in this specific case, of course, the conversations around in what currency is trade being negotiated, in what currency, reserve currencies, for example. Now, what we did get as far as the stuff in dollars, let's put it that, currency weight here, nearly 50% still in U.S. dollars. The renminbi fell to about just over 4%, 4.13. Point of reference, we're coming off a 4.33% currency weight for the month before. So just to give you a sense, a little bit of some moderation as far as that is concerned. But yeah, let's get it back to the top story here, tariffs and all the angles we're covering right now, Bill.
Yeah, well, one of the big angles, of course, is also how China's reacting to this and the relationships that they're building in Southeast Asia. And certainly President Xi's visits to Cambodia, I mean, he's already been in Vietnam and Malaysia, rather, but Xinhua News Agency also looking at this full text of his message in Cambodian news outlets, repeating his message, advocating for inclusive economic globalization. She also says protectionism must be resisted and an open and cooperative international environment maintained.
Now, China is signaling it is open to talks with the U.S. if Washington shows respect and names a point person who can then lay the groundwork for a potential summit between President Trump and his counterpart, President Xi Jinping. Let's bring in our team right now. Our China correspondent, Min Min Lo, our Asia desk editor, Jill Deesis, and Avril Hong is joining us out of KL right now to talk us through the various aspects and angles to this. Min Min, let's start with you. Give us some respect and also tell us who we need to be speaking with.
Well, China actually didn't have a person in mind when they think about that person that Trump should appoint to oversee trade talks, but they just want one person who can speak with Trump's authority to really come to China with a consistent position on what U.S. really wants out of the trade talks, because there's been a lot of confusion, different administration officials saying different things, and China also prefers to have both sides having their own point persons overseeing these talks that would culminate in a leader-to-leader summit rather than having Trump being involved in direct negotiations from the get-go. So they disagree about the process in which this negotiation should go ahead. They also want the U.S. to show some mutual respect to China, and what this means is to rein in some of those disparaging remarks made by Trump administration officials. Our sources didn't tell us any specific examples, but I can think of one, J.D. Vance calling those Chinese peasants. That was something that the Chinese Foreign Ministry had publicly responded to, saying that it was ignorant and disrespectful. And the perception from China is that Trump has huge influence and power over his administration, and if he doesn't disavow some of these statements, it signals that he condones such behavior. And the last thing that China also wants is some willingness from the U.S. to address some of China's key concerns, particularly on Taiwan, to maintain the status quo there, and also to address the perception that a lot of this U.S. policy is targeted at containing and suppressing China's rise.
Yeah, but let's pick up on the Taiwan point in particular. What exactly would they be looking for from the U.S. here, do you think?
It's not very clear, but our sources told us that China was very clear, providing reassurance that they are not going to take any provocative actions, but they will respond forcefully if provoked. And I think we have seen pretty mixed signals because, for example, Trump has said he wants Taiwan to pay for defense, but at the same time, he has other more hawkish administration officials who would be very reluctant to do so. And plus, you look at the tariffs that have been put in place and the narrative coming out from our other reporting showing that the U.S. plans to get other allied countries to get on board to collectively encircle China. I think that is what China is really against, and it wants to maintain the status quo to have the U.S. continue to keep that position of the one China policy in place.
Okay, so that's the China side. Let's also talk about the Japan one as well, because we've had the talks that have already started. It seems like there's signs of progress, and actually we've just been hearing from Japan's Prime Minister as well, Ishiba, speaking in Tokyo this morning, saying that he will go to the US at the most appropriate time for talks, and also that there were some frank and constructive discussions. But just talk us through what we're hearing so far.
Yeah, I mean, look, Bella, I think that pretty much the entire world is looking at what is going to happen with these US-Japan talks, the outcome here, because this could ultimately kind of be a template for how the U.S.'s other allies in particular can negotiate some of these trade deals. I mean, I think that what the U.S. has said, Scott Bessent, the Treasury Secretary, has said is that one reason why Japan is kind of first to the table here and why they're so keen to make a deal with them is because he says, Japan really kind of was one of the first to raise their hands and say, yes, we want to work with you. I mean, I think, from Japan's perspective, maybe it comes a little bit more along the lines of, well, this is a key ally for us in region. The U.S. and Japan, particularly key military allies in the Asia-Pacific, and they were slapped with not just this 24% reciprocal tariff, but they were also really heavily impacted by those 25% auto tariffs, steel and aluminum tariffs. And so, I mean, they're walking into this saying, there's a pretty big, hefty, levies that Japan is kind of dealing with here. And so, the fact that you've got Trump saying, he attended this meeting on Wednesday, that they're talking through some of these trade negotiations, I think that, whatever ultimately results from this, if they're able to actually accomplish a deal within this 90-day reprieve that they have from those reciprocal tariffs, I think that could potentially, again, kind of form a template for other nations that are particularly close to the United States to say maybe there is a deal here that we can make favorable to us as well. 90 days,
do we have a better sense of how realistic a deal would happen? This is the easiest deal to be made if you think about it, right? So do we get one possibly in the next 90 days?
I mean, I would think that if, you see kind of maybe the vibes from overnight, this is already, a bit of a vibes-based administration, that right now things do seem to be kind of on the upswing for Japan. I mean, if you've got Ishiba talking about going to the United States, it seems like his trade negotiator here, Akazawa, this is somebody that went to the United States with actually very little ministerial experience, was actually saying that he found the experience a bit nerve-wracking. But, I mean, if he's able to go to the United States, it seems like they've had something of a promising outcome here. Maybe they do achieve a deal within the next 90 days. But again, David, I mean, I think that what this kind of shows you is that, for the rest of the world watching this, I mean, this is just one deal and a whole host of negotiations that kind of need to happen. I mean, we're talking about a pretty momentous scale here for, the vast majority of other tariffs that are still kind of to hit the rest of the world.
Yeah, simultaneous talks taking place right now. On that note, let's bring in Avril Hong, who's with us out of KL right now, to talk us through what she's seeing on the Malaysia front. Yeah, get us up to speed here, Avril.
Yeah, I think all this tariff uncertainty, and as these countries negotiate with the U.S., it's really drawn countries in this part of the world and China kind of closer together. I mean, you hear from the likes of the Chinese president in visiting Malaysia saying that what they're seeing now is perhaps cooperation with Malaysia, other Southeast Asian countries to combat the undercurrents of geopolitical issues. And we also have the Malaysian Prime Minister Anwar Ibrahim, right, himself saying that what the world needs now is steadiness, reliability, and he says that's something that China needs. So really interesting, because amid all this, the subtext really has been for Southeast Asian countries since the tariff announcements that they have to be friendly with Beijing, but not too friendly in a way that would antagonize Trump. So Malaysia sort of heaping praise on the Chinese president is notable, and also more so than the tone that we got from the likes of Vietnam. Aside from that, we've also seen a number of exchanges of MOUs between the Malaysian and the Chinese side. We've also heard Xi saying that China welcomes more agricultural products from Malaysia, although at this point it's also worth noting that the higher value products of exports from Malaysia to China are more their crude, their electronics products. But the key takeaway, I think, amid all this is more about the tone between the Malaysian and the Chinese leaders, perhaps more so than the agreements that we've been hearing so far. We're also expecting a joint statement from the two sides later today.
Yeah, I want to ask more about that tone, because we saw sort of the pushback from Trump, who essentially said that the meeting between President Xi and also Vietnam's leader as well was sort of aimed at, I'm going to quote him, but screwing the United States. Given how chummy, really, Malaysia and China were in their press briefings and their output from these meetings, do we expect any sort of pushback from the US?
I mean, Trump has been quite outspoken in that regard when it comes to what kind of discussions between China and any ASEAN countries and the form, the shape that's taken. But note as well that at this point, China is really just pushing ahead with its Southeast Asian tour. From Malaysia, he goes next to Cambodia. The Chinese president. There's, of course, the final leg of the Southeast Asia tour. And note that Cambodia is one of the strongest allies for China in this part of the world. Notable as well that when it comes to the U.S. tariffs being threatened out of the Asia region, Cambodia is seeing the highest levies potentially. And this is a country that is very reliant on apparel exports. And so far, what we've heard from the Chinese president is that, they're kind of talking up some of these Chinese investments in Cambodia that are especially related to the Itailu, the Belt and Road Initiative. This is, of course, the marquee project from the Chinese president that's been slowing over the past couple of years. So that's also something that's really interesting to see. But the bigger picture amid all this is really the charm offensive for the Chinese president. You think about how for this state visit from President Xi to Cambodia, to Malaysia. This is something he hasn't done in more than 10 years. So it really speaks to the climate that we're in. Think about as well in the broader ASEAN region. Singapore this week calling for elections, and they are asking the people for a mandate to govern. The Prime Minister talking about how there could be a messy transition globally as the US steps back. So this is really the realignment that we're seeing in the region.
Fantastic. Avril Hong in KL for us, Min Min Lo here in sets, as well as Jill Deese as our desk editor, getting us up to speed here on most aspects of the tariff front here as well. Right, as we try and understand where we are there, markets are steady, stable, trading sideways. You get a sense that we are just a bad headline away from again, just moving to the downside. But we'll see. We'll wait and see what it looks like. We are poised to open lower here across Chinese markets. Right, coming up here on shows.
We've got a really big interview, actually. We've spoken with the Xpeng founder and CEO. The EV maker is saying that it's ramping up their global expansion, despite, of course, as you're saying, Dave, you've got that really big intensifying trade war. But just have a taste of our exclusive interview.
For a company, we expect stability. In any case, stability will bring political, economic, and cultural certainty. And only then we can formulate a clear corporate strategy.
Welcome back. You're watching the China Show, just in time here for the midpoint of the day. Well, the offshore rate is trading just a touch below the 731 handle, on the stronger side of that. The fix is coming in on the stronger side, really, of the midpoint out of yesterday, although the variance from yesterday is minimal, to say the least. So we're keeping steady as far as this goes. But we're still on easing watch, of course, as it pertains to China. It could happen anytime.
Yes, it definitely could, especially when you think about we're going into Easter break, and so it's sort of a perfect time for
sneak one in.
Yes, when a lot of people are going to be off for the next few days. But ahead of that, of course, a lot of the market sentiment today is being driven by Jay Powell. We had his comments overnight, really just stressing again that the central bank must ensure tariffs don't trigger a more persistent rise in inflation. Let's get more with our executive editor on Asia markets. That's Paul Dobson joining us this morning from Singapore. So really, I think for any traders that had expectations of a so-called Powell put, that's sort of been dashed, it seems, at least for now.
Yeah, morning, Belle. Absolutely. He sort of poo-pooed that quite explicitly. And so there was kind of an interesting market reaction because the stock market took it fairly negatively, but the bonds market actually finished the day higher. So I think that traders there were reassured by the fact that Powell is talking about keeping inflation in check. And of course, you know, if it does turn out that the economic downside is much worse than expected, the Fed can always cut interest rates all the same. But I think that being minded of inflation, given what we know about the tariffs now and those risks and the Fed's concerns, it does give us a little bit more insight into the way that they're thinking. They're thinking more, let's keep those prices in check and the long-term inflation expectations in check as well. Less about the labour market and the economy. So, you know, thinking about the dual mandate, that's the side that they're leaning on. And so stocks don't like it, but bonds were reasonably happy with that solution.
We also, let me tie in across the Atlantic. That's the Fed conundrum that they have. The ECB is fairly straightforward, though. We are expecting them to cut interest rates today. Paul, how do I need to be thinking about how just everything then changes meetings after today's?
Yeah, again, well, central banks just have this fog of uncertainty at the moment. Dust in the air, I think one of the Fed speakers was calling it before, because until you know what the tariff situation is, it's very hard to make those decisions about what the inflation outlook is going to be and what the economic outlook is going to be as well. Funnily enough, you know, the euro obviously has boomed higher, particularly against the dollar. Over recent weeks, as there was that sort of narrative of people fleeing from US assets, has given the euro a really big lift. which could, all things being equal, help the ECB in terms of keeping inflation in check. And that might be another reason why they're comfortable cutting interest rates, knowing that a cut like that is not necessarily going to weigh on the currency all that much. So that might give them confidence to be talking a little bit more dovishly and confident in the opportunity to support the economy with the currency kind of working in their favor for once.
Paul, thank you so much. Paul Dobson, there, executive editor for Asian markets. On Paul's point there, on the euro, we've been testing the 114. We did form a technical golden cross, 50 over the 200-day on the euro. You look at implied rates, which we showed you earlier, 100 basis points of cuts priced, including the likely one we'll get today. Speaking of cuts, we're pushing towards session lows right now. 7 minutes to the opening bell. We are poised to open lower across these Chinese markets. Plenty more ahead. A market preview is next. This is The China Show. Welcome back. 5 minutes to the opening bell. More breaking news coming through. This is out of the China side right now, reiterating really the message that they have been underscoring and emphasizing of late, that they do not want to get into a fight, but they will, though, if they are pushed. This is out of the Ministry of Foreign Affairs. China will fight to the end if interests are harmed. It says that it will ignore this number game, I think, to the point they made on Friday, with an increase in their response, and then they said that's it from them. Whatever the White House does in retaliation to that number, they will ignore, which they call then a joke. But yes, that's the latest line coming through here out of the Ministry of Foreign Affairs.
Yeah, and I guess it really underscores the point that you sort of just reach a point where tariffs are already at that level of over 100%. You're effectively cutting off trade anyway. But you can see here we're looking fairly steady in pre-market this morning. Let's take a look at some of the cross assets that we're tracking today as well, because it has been that sort of focus on how negotiations are going that are a little bit more positive, like Japan, for instance.
Yes.
That's certainly playing into the sentiment this morning.
No, absolutely. And I think we did get the lines coming through earlier on from the Prime Minister that momentum is really pushing towards the direction of a deal. And I think that the point that Jill Deeses was making earlier on, our news desk editor, as we flip the page and look at the others as we look into the open today, that could be the template to watch what they've managed to hammer out between the U.S. and Japan. But all the caveat there is that is actually the easiest deal to be made on the table, given that Japan is an ally, a military ally specifically too.
And just taking a look at some of the stocks we're watching, in particular Kingsoft Cloud. So the story here is that nearly 70 million new shares of Kingsoft Cloud are going to be issued to Kingsoft. That's the parent company, of course, but according to a statement that was filed to the Hong Kong Stock Exchange. Also taking a look at some of the Chinese internet giants, because Citi's just issued a new call saying that they're going to be facing margin pressure on the trade war, even though we actually have seen companies as well saying they will support merchants that are on the platform. So more ahead with the open. You're watching Bloomberg.
Right, welcome back. You're watching The China Show. We're counting down to the open, 40 seconds away. We are right at about the level, I'm talking about the Hang Seng Index and the Hang Seng China Index, right at about the level where if we see even a couple of points to the downside and close at these levels, it would be a 6th week of losses, which would be the longest losing streak on a weekly basis going back 10 years. Imagine that. But in terms of magnitude, though, I mean, a 1% loss here and there is not really a big thing, too. But more on the breaking news out of the Ministry of Foreign Affairs here.
Yeah, this has been something that's just come out in the last couple of minutes, but essentially Chinese officials sort of responding to the tariff, because we had the US overnight saying that it could be up to 245%, but essentially they're saying that they will continue to fight their interests, or rather to the end if their interests are harmed.
Yeah, okay, hardening the stance. Well, that was really the stance that they have been putting out there for a while now. And I think the reference there is to that number, in case you missed that 245%, was effectively the latest tariffs and then the 100% before that were applied to other other goods. Declines across the screens right now, and of course we're in case you missed it, we are going into the thick of earnings season as well. Declines across some of the big names here. A glance at the CGB curve right now, 164 right now. We had a slightly stronger fix compared to yesterday. A bit on the weaker side, though, and you are getting a sort of move of a little bit as far as offshore currency is concerned. Let's have a look at Hong Kong, please. And, we mentioned a couple of levels to watch. We'll get to that in a moment here. But just below, I think, the 21,000 handle on the Hang Seng Index. On the 8 shares, we are, in fact, right now on 6 weeks of losses when you look at that. We're looking at tech, gold producers. We're looking at some of the chips on the back of the NVIDIA story. It turned out not to just be NVIDIA. You had AMD, you had ASML, of course, and, $2 trillion in market cap has been wiped out of sort of the chip space, broadly speaking. We're down about, I think, 20%, if not mistaken, on that gauge there. Now, a couple of stocks that we're tracking here. Long E Green and also Samsung. The vice premier actually visited. Can we go back to that? I'm quick. I'm not that quick. We talked about Long E Green. Zijin Mining, thank you so much. Continuing to catch a bid. I think gold is coming up on your screen. So we topped 3,300. You know what? 3,400 is, in fact, already showing up on contracts towards the end of the year. So don't be surprised if we knock on that door, if not already. I'm ready to flip. Let's go. Let's go, please. 6 weeks of losses right now would be the longest streak in 10 years. The levels to watch, bottom of your screen, 78.01 on the Hang Seng China, 20,914 here on the Hang Seng Index. We have some breaking news, Belle, out of Australia.
Yeah, jobs numbers have just come out. I mean, everyone knows that this is an extremely volatile data set, and I think it's just been proven once again because it's come in job creation of just over 30,000. The estimate had been for 40,000. Certainly a major rebound, though, because we had that huge dive in February where we saw a contraction of more than 50,000 jobs. So that's the Aussie print there. We can sort of leave that, just a bit of weakness of the Aussie against the greenback, but again, we're seeing a bit of dollar strength today as well. Taking a look at the Korean won picture today too, because we had the BOK electing to keep its rates steady earlier, but we're just getting more details on essentially the meeting today, saying that the CPI core inflation likely to meet expectations. They're going to continue to monitor the FX household debt. That's been a really big concern in Korea as well. They're seeing some weakness in domestic demand, but they do expect that to ease. And also exports are likely to continue their weakness, and that's, of course, down to the trade issues.
Yeah, and we'll get more context and details on this. The briefing will be taking place, if it is on schedule, this time in the next hour. And certainly one of the things we'll be watching out for there is the openness and what the voting looked like in this meeting, and how open those board members are to any changes with the upcoming meetings after this. Certainly this is a forward-looking story. Right, speaking of forward-looking, we're looking ahead to earnings out of TSMC out in a couple of hours here. Fantastic chart, by the way, from Charlotte Yang and her team here, putting together a consensus rating. So what you're looking at right now is, the score from 1 to 5, 1 being the most bearish, 5 a perfect score as far as, overwhelmingly bullish calls, not a single neutral, not a single sell call. What's taken place in the last, I would say, 2 weeks is that what's normally almost a perfect score in TSMC has been pared back a little bit. So I think you had 2 analysts who have abandoned either their buy or outperform ratings in April, and that's taken the score down to about 4.8, which effectively is the lowest in about since 2024, if not 2023. On a valuation perspective, we are trading on a multiple. This is the cheapest, quote-unquote, cheapest TSMC going into an earnings in about, I would say, 2 years or so.
Yeah, it's kind of like a grade A student.
Like you. Like you. How does it feel?
It's underperforming a little bit, but still, I mean, it's doing very well. When you think about 93% of analysts are still recommending the stock, but 98% had been doing that. Just
I did horribly in school. I don't know how that feels.
The pressure. Anyway, let's bring in our Asia Equities reporter, Charlotte Yang, joining us in studio. So, I mean, lots are still optimistic, but why just a little bit less positive right now?
Yeah, so like you said, it's a grade A student, so I think people have a high expectation. But for TSMC, we've already know that the 1Q sales came stronger than expected at 42%. But I think what everybody's watching is whether there will be any change to their full-year sales guidance, which they earlier said it would be expected to grow by mid-20% in US dollar terms. And now we have JPMorgan expecting that, them to lower down that full full-year sales guidance a little bit, while Deutsche Bank says there's a possibility that they might just pull, its full-year sales outlook altogether. And also, investors are watching any comments on tariff potential impact, and also any clarity on the reported joint venture with Intel, which a lot of people didn't like because they're worried about this kind of. First of all, the two companies, they have different set of business models and also tool sets, and they're also worried about such investments weighing down on the long-term profitability. So we're looking at options market also showing some signs of caution, heading into the earnings.
Yeah, to your point, Charlie, it's hard to look at TSMC in a vacuum because massive sell-off overnight in some of its customers, right? NVIDIA and the like. What will the guidance mean for global markets?
Yeah, so if you are looking at the pricing actions overnight after that earnings disappointment with ASML, and they said it's so hard to quantify the tariff impact. We saw the Philadelphia Semiconductor Index down 4%, and TSMC basically the guidance I think it will be so like in the near 2 weeks, next we'll have Intel, and then later than that, Apple and Microsoft. Basically, what TSMC provides guidance-wise will be I think the key tone for these global tech stocks. And also, let's not forget how important TSMC is to the local Taiwan equity market. It's the highest member in the TAIEX index, and also means a lot to the whole supply chains.
Absolutely. All right, that was our equities reporter there, Charlotte Yang. And for more on the broader chip sector, we're also going to be speaking with the head of Taiwan research at UBS. So we'll discuss the impact of tariffs on the global supply chain, as well as other risks that are affecting chips and tech hardware. So stay tuned. That's coming up in just over 20 minutes from now. Yep,
there we go. Now, taking place back to the here and now, let's talk markets, the outlook, and really how we try and distinguish signal from noise. Joanna Shen is here with us, emerging markets, Asia-Pacific equities investment specialist at JPMorgan Asset Management, in contact, of course, constantly with the banks and the asset managers' clients. How do we distinguish signal from noise? What are you looking at as far as signal, and what's noise?
I think, to quote my dad, sometimes you can actually see more clearly if you remove your reading glasses. Okay. So said differently, if investors zoom out and see the picture, big picture, it might be better for the current environment. I don't know about you, but what happened last week, it feels like watching Trump's Apprentice. With lots of twists and turns and
with some
suspense.
of the same cast, though, I would say.
So I would say the current market volatility is largely driven on geopolitical tension, especially the uncertainty around the tariff policies. We could be one tweet away from everything being reverted, I think. So the unpredictability makes it really hard to bottom the market or time the market. But if you look at, the big picture, is 3 months or 6 months fast forward from now, we will see a lot of earnings downgrades. Companies will give no guidance or tough guidance. But the direction of travel for the tariff in the long run is to normalize from the level announced so far. And if you look far beyond, what will drive the company earnings is the management capability to weather through the challenge period. So in the short term, it's really hard to predict the market because all sorts of stuff, news flow, earnings, you have politics and more politics. But in the long run, it is the earnings that will drive the stock market return. So in that sense, I would say stay calm and carry on.
Okay, stay calm, carry on, but in what fashion do you carry on? How do you actually look at constructing a portfolio or finding new opportunities then right now?
Yeah, sure. If we just take us back to through the lens of Asian equities. So at the moment, we will say the domestic-oriented economies, the likes of China, India, Asia, telcos, regional telcos, or Australia, the staples looks reasonably okay or relatively defensive under this market. If you look at our portfolio constructions, by and large, I think we have been trimmed more rate-sensitive plays because of the rate outlook in the U.S. and also the financial names have been doing quite well last year. So it is a pocket of profit-taking. But on the other hand, we've been adding to more domestic-oriented names in China, in India, as well as in Southeast Asia, some of the internet names.
When you talk about, I think it's interesting because when you that's a good observation, by the way. When you flag the the likely earnings downgrades we'll see in 3 and 6 months? I mean, markets look ahead, so arguably I guess my question to you is, do you think from a fundamental perspective, markets have priced those earnings downgrades down the road, do you think?
I think we have partially priced in some of the bad news, but the thing is the volatility or the uncertainty make it hard to fully price in what will happen.
Right.
So that's why in our research framework, we don't really track the earning on a quarterly basis. Our investment framework is on a normalized basis. So what our analysts have been doing over the last 10 days actually is to rejig the number based on the new assumption on the macro side, whether it's the GDP, whether it's the rates, whether it's the normalized tariff. I mean, it's really hard to call. I think the earning forecast is getting harder at this time, leave more room or margin for errors at this stage. But it is better to be approximately right than precisely wrong. That would be our stance.
Yeah. It's funny how lots of people get that one wrong, actually. Can we make the assumption at least that the worst, not the worst in terms of pricing, but the worst information is already
I think
out
in
there?
terms of the damage from the tariff announcement have largely peaked. And the direction of travel, as I said before, is for the tariff to go normalized, especially when the U.S. realize it is actually doing itself a damage, not just the other counterparts.
And does that also include for China as well?
Yeah.
So in terms of China, actually, I was just in Shanghai seeing clients. You know what? Most of the conversations around whether the U.S. exceptionalism is over, whether China will see a resurgence this year. So I think if we sort of go back to the DeepSeek moment, it is a very good reminder that in China there's still ample innovation, still a lot of animal spirits or entrepreneurship, as long as it is not get suppressed. And we can say the rehabilitation of Jack Ma in the private sector symposium in February is a very important reminder in this regard. And what DeepSeek did is not just showing China's innovation, but also a boost to the Chinese confidence. I think that's really important. So in terms of the market expectation, we all think, down the line, more stimulus will come. So the key watch point for us is the July political Politburo meeting. We think the April Politburo meeting is likely to front-load the implementation of existing stimulus policy, which is announced during the 2 sessions. But that part doesn't really count the tariff impact, which may not be sufficient to mitigate the negative shock. So down the line, we are watching for more triple R cuts, maybe the more issuance of the government bonds, acceleration of the housing market destocking. But I would say we should caution that monetary policy alone will not be enough to take China out of the deflation mode. We've seen this from Japan, from the GFC. What is missing in China so far is a very ambitious fiscal program. Whether it's to on the consumption side, because you look at the China's contribution to global consumption is only 12%, but China's GDP contribution to the world is 20%, and its manufacturing contribution is 36%. So obviously, there's a lot of rebalancing needs to be done.
Interesting. Can I pick up on your conversations with clients on the mainland, right? And I think from an earnings exposure, I think MSCI China doesn't really get a lot of foreign exposure in earnings. I think it's below 20%. I think exposure to the U.S. is below 5%. So where I'm going with that is, do your clients in mainland China actually care more about tariffs, or are they more preoccupied still in terms of mind space with the domestic stories? DeepSeek, consumption, lack of inflation, what have you?
I think in the context of trade friction, it is really important that China has a huge size of domestic economy. So as you just mentioned, MSCI China's revenue exposure for
What's
markets
the number?
Outside China, it's only 13%.
Okay.
Yeah. So U.S. contributing only 3%.
Okay.
So in that sense, it's about whether China can make that 3% or so. So the key thing, again, is more domestic driven, whether there will be more stimulus, whether there will be rekindling of the animal spirits. So that's the key watch point.
Joanna, great to have you this morning. That was Joanna Shen there, Emerging Markets Asia Pacific Equities Investment Specialist at JPMorgan Asset Management. And actually coming up, great interview as well, because just talking about animal spirits, consumption, Chinese innovation, we're going to be speaking with the CEO of EV maker Xpeng, that's He Xiaoping, of course, discussing plans to expand outside of China. That's even when you've got the storm of this escalating, ever-escalating trade war. We'll have that next. This is Bloomberg.
Right, welcome back. You're watching the China Show. Let's talk about Xiaopeng, Chinese EV maker there, of course. Well, the company says it's still optimistic about its overseas ambitions and plans. The company hosting its first global launch with the new X9 minivan here in Hong Kong. And the founder and CEO, He Xiaopeng, spoke exclusively with Bloomberg about the car maker's localization plans and also growing global trade challenges.
对于一家企业来说，我们期望是稳定性。
For a company, we expect stability. In any case, stability will bring political, economic, and cultural certainty. And only then we can formulate a clear corporate strategy. So we deeply believe that stability is above all. In fact, Europe is the focus of Xpeng's globalization strategy, and we will strengthen our business in regions including Southeast Asia, the Middle East, Central America, and South America. However, we still hope that one day, more Chinese companies will be able to expand their businesses into other countries, including North America, under stable policy conditions.
We know that the Chinese and the Europeans have restarted talks about this minimum price mechanism, potentially to replace the tariffs, which can go as high as 45% into the EU. How would that affect your plans for the European market? Potentially, would that mean scaling back on the immediate need to have your own production bases in Europe?
We have noticed this news, but I believe the talks are still in the early stages. For me, the certainty lies in the tariff policies that China and Europe clearly implemented last year. As we Xpeng, we firmly believe that only through localization in areas of localized R&D, service, manufacturing, and sales can we ultimately achieve comprehensive globalization. So we are working on how to better implement our localization strategy in Europe and other regions. In the future, we will announce our localization strategy in certain countries and expect to have more localization strategy in more markets.
Let's talk about chips, because you need these chips across the board, whether it's your flying cars, your humanoid robots, your industrial robots, and of course, self-driving robo-taxis and the like. How critical was it to build these chips in-house, not necessarily rely on the NVIDIA Thor chips and create your own Turing chips? Was this because it's cheaper, or because of export controls, or because you have to meet certain requirements from the Chinese government that more chips in these kind of products need to be made in China?
Actually, companies like Tesla and Apple are developing their own chips, and they're certainly collaborating with NVIDIA and many other chip suppliers. According to our research, each Xpeng vehicle contains 5,500 chips from global suppliers. Given the large number of chips, the reason that Xpeng is working on the in-house chips is that we hope we can leverage our own capabilities. For instance, if we aim to achieve autonomous driving and use global autonomous driving systems, we need chips that can help our autonomous driving perform better in conditions like nighttime and glare. We hope to maximize the performance of the chips, and at this point, there is a huge value of customized chip. So in the future, we believe we will collaborate with many chip suppliers, including NVIDIA, while continuing to focus on developing our own customized AI chips.
That was the Xpeng CEO He Xiaoping speaking exclusively with Bloomberg's Stephen Engel. Now to some of the other headlines that we're tracking in the auto sector this morning, starting with what Bloomberg has learned about Renault, because two executives are going to be stepping down from Nissan's board of directors. Sources say Renault's chairman, that's Jean-Dominique Senard, and another representative will leave their posts. That's after earlier opposing Nissan's plans to combine with Honda. Nissan's seen a broad leadership shake-up after its failed attempt to merge with Honda back in February. To Ford now, and it's preparing to raise prices on cars starting next month. That's if President Trump doesn't deliver on the tariff relief that he's already hinted at for automakers. A memo to dealers says the increase will affect Ford vehicles built in May. That's arriving in US showrooms from late June. It's the clearest sign yet that we've seen that automakers are likely to pass on at least some of the higher costs that are brought on by Trump's 25% tariffs on imported cars. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, that's TV Go. You're watching The China Show, and this is Bloomberg.
Right, about 24 minutes into the cash market session here, and we have, in fact, when you look at Hong Kong specifically, we've shaken off the early cobwebs and now up about, let's call it 1%, splitting the difference between the Hang Seng Tech and Hang Seng China Index. So we might just avert a sixth week of losses here. Headlines coming through out of the Ministry of Foreign Affairs just this hour. You can read about that bottom of your screens. We have lots more coming up here in shows.
Yeah, one thing to note actually about Hong Kong, trading volumes are very thin, nearly 90% lower than where they'd typically be. But coming up next, UBS joining us to talk about TSMC's earnings.
Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored. We will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
That was the Fed Chair Jay Powell speaking at the Economic Club of Chicago, and certainly his comments did put a note of caution into markets, because I think a lot of investors sort of had, I'm not going to say expectations, but maybe some hopes of some sort of Powell put and some expectation that maybe he'd be willing to put a floor under asset prices. But certainly when you take a look at his comments in aggregate, it seems like they're more concerned about really those longer-term inflation expectations as opposed to cutting rates to try and ward off any sort of recession risks.
Yeah, I think that's a good point, because he's highlighting this time around as, I guess, the difference between now and the past times where they've come in with that put is that their mandates are at tension with each other, where you have inflation, to your point, pushing higher. So they're comfortable to wait, and I think they say they do have scope to wait, which I think is it's maybe the silver lining, if you want to look at it that way. Across these markets, though, so it's also important to note that we're going into the sort of Easter weekend, so you have a couple of markets that are just trading right now for the last time before we go into the long weekend. Hong Kong's a case in point, so the orientation just might be to either not take too much risk, or I think when you look at price itself right now, we just showed you Hong Kong there before I talk about the ECB. You know, prices on the way up, but volumes are just nowhere to be found going into, you know, we're on holiday on Friday tomorrow and also on Monday here in Hong Kong. So that's a nice 4-day stretch for you guys at the airport right now. Thank you for tuning in, by the way. There's no need to. As you board your flight. ECB, later today, near consensus. I think among all the forecasts out there, nearly all have a cut for one rate cut today, 125 basis point rate cut to be more specific. There's one forecast that has a 50, one forecast that thinks the ECB will need to stay on put right now. What does it mean for the currency? The currency, of course, has been really moved on dollar weakness. Euro dollar, 114. Nice round number, which also happens to be quite clearly your resistance level. We've been consolidating just below that. We've been testing that a couple of times. The last time we were trading at about 113.96 was on Feb 16, 2022. So yeah, we are back to about 2.5 year highs here in the euro. We did form a golden cross, which I guess gives you a sense of momentum there. So we'll see what the guidance coming is throughout of the ECB. Also this hour, as we change the boards, please, and have a look at gold futures are now down, in fact, as you can see across the board. We'll have the Bank of Korea. Yes, and you know what? That's the nature of news. Okay, thank you so much for that. The headline we just wrote right now. Okay, the Bank of Korea is set to begin their briefing this hour. We'll see what they say and how they frame it, what the voting was like, how open they are to moving. They did hold interest rates there, of course. And the broad read across markets is we're stable, if not moving to the upside. On the Asian benchmark of 51%, a lot of that is the pickup we're seeing in Hong Kong and Japan. And S&P futures are now, in fact, trading at about session highs at about these levels. We're on earnings watch as well here.
Yeah, earnings watch with TSMC, but I think sort of that sentiment in the market is really being driven as well by these trade talks and you know, the optimism maybe that came out of Japan. It's really seen as a bit of a litmus test of okay, how does Japan go? What does that mean for other countries that are also looking to talk with Trump or US officials in the Oval Office? But certainly the direction of travel this week in Asian equities has also been the tech story, because you think we had NVIDIA with the $5.5 billion write-down because of the H20 chip that they can't send to China anymore. Then you had ASML talking about sort of a weak outlook as well and a miss there on their orders. And then you count down to the sort of behemoth or a behemoth in the market, and that's definitely TSMC. So let's talk about the impact of trade curbs on chips, tech hardware. Bring in Randy Abrams, head of Taiwan research at UBS. So, Randy, I know that you can't talk stock specific, and I'm going to also let viewers know that too, in case they're wondering why I'm not starting off and asking you directly about TSMC's earnings that are due later. But in aggregate, when you stack TSMC expectations up against ASML, up against NVIDIA, what does that tell you about the direction of travel?
Okay. Yeah, no, thanks, Annabelle. Good to be on. So I would say the world has changed a lot since we had the last time we saw a lot of these companies 3 months ago. We had the April 2nd Liberation Day with all of the tariffs across the board. Then soon after, 90-day exemption reciprocal, and then these tech tariffs, a temporary exemption. So a lot of volatility and a lot of uncertainty with that of, if we look forward, what's going to come back on for tech, semi and hardware tariffs, and what's going to come back on for reciprocal tariffs. Netting that out, I tend to think as we go into results for companies' outlook, the very short term, if we take just first quarter when they're reporting the revenue that companies delivered, actually first quarter for Taiwan tech was strong. It was actually 5% above expectations. But a lot of that was a bit of restocking from a trail-off end of year, but also a lot of tariff pull-ins where companies are trying to rush out shipments. And with these exemptions, the result and outlook for immediate second quarter is actually fine because companies are trying to get products shipped with the fear that they would pay tariffs higher. And there's a lot of uncertainty on that. I do think, and if we go back to what companies were doing in April of 2020, at that time there was a worry with the lockdowns, COVID would slow things down. So companies, as we go through results, will at least flag that there's more uncertainty in the environment and that there is some potential risk of slowdown where we pulled in components, so some inventory adjustments after the pull-in, and some degree of demand slowdown where consumer and business have to absorb these tariffs. So to that, I do think companies will acknowledge that there is more uncertainty, a wider range of outcomes for second half, and potential drags that we didn't have to deal with 3 months ago.
Randy, David here. So what does that tell us then about what earnings might look like, not just this quarter, but in the succeeding quarters? It feels like, I guess to your point, some of these companies have simply brought forward what would have been earnings a few months down the road.
Yeah, I think that's a good question. And there's two ways we can look at stocks. There's the just multiples, the PE, and then there's the E, which you mentioned. I'll start with the easy part, the PE, because stocks have corrected to anticipate that earnings are going to have some cuts. We've actually taken out most of the re-rating from the AI cycle, where if I look at the Taiwan universe, last summer we were trading closer to 20 times earnings. Now for the universe, we're 14 times the next 12-month earnings, and on 26, we're 12 times. That's back to average. So we've taken out the re-rating. If there's the downside risk or the risk now, it's to the other side of earnings. And we do have prior cycles to look at. Starting point, the mini trade war in 2018, that was a 10 to 15% risk to earnings, or 10 to 15% off came off of earnings at that time. From cycles of the last 10 to 15 years, it was 10 to 30%. GFC, financial crisis, was over 50%. So hopefully we don't go that extreme. But yeah, I'd put that bucket 10 to 30 if we don't get the flexible side of Trump. If we do get fairly heavy tariffs, that could be the type of risk. And it's really because you'd have some demand come off, especially to US, where our team's sensitized. If you were to lose 10 to 15% of PC and smartphone demand in US, that's a few percent off global units. But there's an earnings multiple compressing sales. You compress earnings a bit more. So I'd put my case, yeah, in that 10 to 20%. Steeper case that we get heavy escalation leads to a bit bigger downturn like some of the harder ones.
But do you think it's fully priced in? I think as well, a lot of the story around the stock and talking about TSMC, but a lot of tech names this year hasn't been so much on trade tensions. Of course, you've had that in the last couple of weeks, but also a lot of this story was around DeepSeek. We saw Microsoft pulling back from investments into data centers. Yeah. So have we fully got the trade story baked in right now?
Okay, I think to that, because there's uncertainty about it, we priced in the first part. I mean, it was a shock to the market when April hit that woke people up. At that time, they were talking dirty 15, and it was broad reciprocal, where it's like, wow, this is going to be deep and broad. Some of that has come off, but it's temporarily come off. So if I think now about pricing in, there are 3 events still ahead of us that the market has to just watch out for. And 2 of those we talked about, the tech tariffs on semi and hardware. Trump's indicated we still are going to come back with those. So let's see the magnitude. If it's a heavy magnitude like we saw with auto, 25% on tech and hardware, that will be a lot for supply chain to absorb. Then the end of this quarter, reciprocal tariffs. How much do those get negotiated down? If it comes on with mid-30s tariff on a lot of countries, that's a second thing we have to absorb. If I say the third, I think it's more of a consumer tech, more than server, but areas that we saw pull in first half, potentially second half is just a little bit weaker as you digest some of the inventory you pulled into a slowdown. So those are just 3 events that you just need a little bit more time to work through how those outcomes are, to say, hey, the market's at least absorbed a few of these shoes to drop or shocks that we still have ahead of us.
Randy, I want to also ask about the visits that you've been making to different Taiwanese companies in the semiconductor ecosystem. One of the big challenges of Taiwanese companies is, of course, just straddling the US-China divide, because even though a lot of these companies have major customers in the US, they've also got a lot of business that they're doing in mainland China. How are they navigating that very delicate balancing act right now?
Yeah, I mean, Taiwan's trying to do what they've done, exactly that. What you mentioned is straddle both. And I'll say to that, they are trying to keep the production that they can. And so there's a base where they're now, with their navigating global, is China they can use as a base to supply China and Belt and Road kind of emerging markets. And what you are seeing, though, is and they have to navigate now the other part. It used to be, I'll just go to either Mexico or Southeast Asia. It's a bit dynamic. In the very short term, the USMCA, the Mexico-US trade agreement, is allowing them to use that base to ramp up production to ship into the US. So there's a piece, I'll just say, they're going to try to protect the core, what they can keep in China to supply some non-US demand. for the U.S. demand, and it's going to be more about where do I move to mitigate my tariff exposure. And I'll just say what Taiwan is trying to do is you've seen a lot of announcements to, I'd say for U.S. know the direction U.S. wants them to go, and that's why you have seen companies like Hanhai, TSMC, Wistron have announced bigger facilities or even get involved with companies like NVIDIA when they put out these big headline numbers. Taiwan's trying to get involved with that. They know they have to play both sides, keep production in China, continue to supply that market where they can to come in and support, but where they have to supply, especially things like U.S. data center, they are showing their willingness to be in North America for that.
But so far, they've kind of held off from moving the most advanced production off the island. So do you see that actually shifting to the US? And also, how does it sort of then also dent maybe the silicon shield to an extent?
Yeah, one cushion I'll just say is TSMC, and I think they'll say again on their call, they still, the way they've set up R&D and manufacturing, they have to keep, for their design to bring up the technology, they need to bring it up close to R&D in Taiwan. And that's actually suits, in a way, AI, because it's actually not on the most advanced node. It usually is about 2 years behind the very latest advanced technology. So they can start with things like smartphone, bring up the process with smaller chips. And then when you have to build these big, complex AI systems, it's actually a less aggressive node. They can do that about 2 years later and start to bring that up into US with a lag. But I'll say for the silicon shield, it's two things will still be there. One is that advanced node is still central. They have to start there to bring up the process first. Second, even if they do these fabs that they're planning 3 phases in Arizona, you're still going to have 80% of that installed production base that is just extremely expensive to move. That's still going to be in Taiwan. That would still disrupt global economy for years if that capacity is disrupted. So that's also a shield for, you could say, across the globe, the risk of disruption of that capacity.
Randy, I'm not sure how to ask this without saying it,
Okay.
Saying the actual phrase, but I think you might understand where I'm going with this. Let's use Korea as an example, right? The Korean market, because of the geopolitical situation there, tends to trade. There's a risk premium that's built into Korean stocks, whether that's the Korean discount or corporate governance or something else that they share a border. That's where I'm going with this. And I'm wondering, the close trade relationships, globalization have put the price tag up for military confrontations. And now that it seems that we're moving in the direction of, bear with me here because I need to just flesh this out, in the direction of maybe a decoupling, bilateral decoupling of a trade relationship between the U.S. and China, it then increases the tail risks of certain events. And I'm wondering, how do investors need to be thinking about tail risk events and the consequential risk premium that we might see get built into the entire Taiwan equity universe as a consequence of that?
Yeah, if I go back to 2022, at that time, there was probably some geopolitical, I think, after, so you had well-publicized visits to Taiwan that was a factor alongside the COVID correction. So the market at that time did discount both. Now, what did come out, and I'll just say for Taiwan tech, it comes back to straddling. As long as they kind of keep this core position in the tech supply chain, which they've actually been able to navigate pretty well. We started some of these export controls in 2018, and we're 7 years later. We did see after COVID, after some of those sensitive visits, that Taiwan still re-rated quite a bit after ChatGPT for the last 2 years. Now we're kind of navigating uncertainty on tariffs. I'll just say if we kind of stay in this environment, that's kind of a different discount. It's uncertainty that affects the multiple. Our take, if you kind of get through that with Taiwan straddling, ability to still kind of drive the advanced technology, investors actually do come back when they see, I'd say they lead toward a base case rather than a black swan case. And if they're kind of investing for the base case, we did see it with Taiwan market. It recovered from 22 quite well. I tend to think the same if we kind of stabilize through tariffs and get back to a place where, hey, they're actually still supplying a lot of these AI servers to global, still able to supply some of the consumer products in China. That still allows them to command some premium. Under this scenario, we kind of keep a base case rather than a black swan case.
Yeah, just on that, I guess it's always interesting, though, you see the ADRs trading at a premium to the Taipei listing, and that's one of the reasons is the geopolitical risk. But last question relating to the news with NVIDIA and this restriction around the H20. We did see that huge sell-off in NVIDIA. The tech names in Asia, though, that you might have expected to see proportional losses kind of held up better than expected. What's the impact that you're seeing?
Yeah, impact. I look at the guys building some of these AI servers. It tends to be within their business. So recall, it's not their whole business. The AI server business, maybe 30–40% of the revenue for some of these hardware suppliers. So if 10% of that is going to China, it ends up about 3–4% of their business that gets impacted. So to an extent, it's still there, but it's maybe moderated by the fact that you have the other part of the business. I do think that was one part. Probably also is in the press earlier in the week, still some relief from the temporary relief from the reciprocal tariffs, I think was still, or the tech tariffs, that was still helping the ODMs. So it's a marginal. We kind of put it as it is a mild impact. It's not a severe impact, but there is some impact with that. And so I just say, for now, it comes back to you're getting rush orders for consumer and server through first half. So it won't be the immediate impact, but second half, you could say that's where we get to a little bit of a drag. The rush orders come off, and now you have a few percent less you're getting to your total business, not being able to ship some of those GPUs into China.
Randy, thank you so much for the time there. I think we covered quite a bit of ground. Randy Abrams, the head of Taiwan research at UBS in Taipei for us there. Right, plenty more ahead here on the China Show. Right, we'll take you straight back now to, well, right side is the Korean won, the left side is the ongoing briefing out of the Bank of Korea where they're unpacking the details on that rate decision broadly to hold interest rates. The reason I say broadly, because now we know that there was one member who actually opposed that decision. It was not unanimous, stating the obvious here. And it seems that one member was actually in favor of cutting interest rates. There we go. So it opens up maybe the door. We'll see how the macro progresses over the next few weeks into the next meeting. But yes, one member suggested a 25 basis point rate cut today.
Yeah, and also issues in the economy. I mean, they've already flagged that exports could slide based on these trade issues. And that is, of course, the top story today. Can move to China now, though, because they're said to be open to trade talks with the U.S. That's if Washington is prepared to show some respect and take a more consistent position. Let's get more with our China correspondent, Min Min Lo. This is a really great scoop, Min Min. So talk us through what are the details of it.
Yeah, so I guess this is the clearest clues that we have yet in terms of what China wants to see before they would be willing to agree to trade talks. And one of the things that they want from the U.S. is to appoint a point person who can speak with Trump's authority and to clarify what exactly the U.S. position is, because there's been so much confusion over what the U.S. actually wants out of these tariff talks. And China wants the talks to be overseen by 2 point persons from both sides before leading up to a leaders' summit, instead of having Trump being able to have direct access to see in negotiations right from the get-go. And this comes as there had been a lot of confusion over the 245% tariff, which appeared in a White House fact sheet. And the White House had clarified that there is no escalation of trade tariffs. It's still 125% reciprocal tariffs plus the 20% fentanyl-related tariffs, so a total of 145. 245 is the cumulative tariffs that some goods could be exposed to because of the pre-existing tariffs under under the Biden administration, where you have the likes of electric vehicles being slapped with 100% tariffs. And so we heard from the Chinese Foreign Ministry, also the Commerce Ministry, saying that this is a meaningless numbers game that they're not willing to engage in, and it just shows how absurd the U.S. has been in using and weaponizing tariffs in this trade war.
Min Min, thank you so much. Min Min Lo, our China correspondent there. We'll continue the conversation around this with the Chinese president, of course, going from Vietnam to Malaysia to Cambodia, and joining us in a couple of minutes, founder and CEO at Strategic Counsel, founder and CEO Hafidzi Razali will be joining us at those times on the screens as the Chinese president continues his tour of Southeast Asia.
Taking you back to this briefing that's happening this morning in Seoul, we've just had the Bank of Korea meeting coming out, and we did have one dissenter for the current decision to stand pat. Someone wanted to cut. What's interesting, though, what is unanimous is that all of the 6 members are going to be open to reducing rates in the next 3 months. So they're essentially saying back in February they were just too optimistic.
Yeah, and the growth forecast, but certainly the world has changed a lot since that point in time. So yeah, I mean, it certainly does open up more downside, as you can see, which is slightly happening right now as far as the Korean won is concerned. We'll see how this plays out. More coming through on this, plus others, here on The China Show. Right, welcome back. 11:29 over in Tokyo. Yeah, that's a live shot of Tokyo here on Earth, where Katy Perry and others are back.
After 11 minutes.
Yeah, almost got there. Which is interesting because you juxtapose that story of Katy Perry, Blue Origin, they're back on Earth, 11 minutes, and then somehow you look at, I'm just using the Bank of Korea as an example, but in no means singling out Bank of Korea. We can't seem to get our projections right on growth here on Earth, but somehow the James Webb telescope was actually able to spot, get this, Annabelle, fingerprints of a molecule on an exoplanet 120 light years away from Earth. So we can figure that out, but somehow we can't figure out how to run our affairs here on this side of the world. In any case, of course, it does help that we are managing our affairs to the point that Governor Ueda is talking about there, with some soundness, financial soundness in mind. On that note, the Bank of Korea is signaling that they might be open to rate cuts over the next 3 months. We do have, of course, 2 more meetings. I think one is on May 29th and July 10th are the next 2 meetings out of the Bank of Korea, and all 6 members are open to rate cuts there.
I never, ever thought it would be possible to put the BOK, the BOJ, Katy Perry,
James Webb Telescope,
into one sentence or thought, but that just gives us an insight into your mind, Dave. Thank you for that. All right, taking a look broadly at Asian markets this morning, and I can be a little bit more streamlined. Look, you can just think about Jay Powell and you can think about trade negotiations, because that's really what's dominating the sentiment this morning. You're seeing Asian equities that are picking up. US futures have picked up as well. Tech's a little bit under pressure, and we're, of course, awaiting the big TSMC earnings later today. That's going to definitely give more signals. We already had ASML giving a pretty dour forecast. We've seen Nvidia looking at a $5.5 billion write-down because it can't send H20 chips into China anymore. Dollar gauge is fairly steady right now, the APAC dollar gauge, but that's really it. Jay Powell sort of pouring some cold water, but then we've seen some improved negotiations on the trade front. And China as well, I'm not going to say issuing an olive branch, but certainly sort of like starting to lay out some of the conditions that would bring them to the negotiating table. So let's take a look at how that's being reported on in China's official media as well, because state media outlets are playing up China's latest growth numbers, saying the economy got off to a good start. They're actually projecting confidence in economic fundamentals while brushing off the long-term impact of what they call abusive tariffs, that's by the US. Meanwhile, ahead of President Xi's arrival in Cambodia today, Xinhua has published the full text of his message in Cambodian news outlets, repeating his call for inclusive economic globalization. Xi says hegemony must be opposed, protectionism resisted, and an open and cooperative international environment maintained.
Now, today's editorial, you look at a China Daily here, hailing ties between and of course, we're going back to this trip that the Chinese president is on across Southeast Asia. The ties between China and Malaysia and the broader Southeast Asian region, it says the warm reception given to President Xi shows the region is ready to work with Beijing to, quote, build a neighborhood community with a shared future. But it says China is not demanding that its neighbors pick a side, but instead urging them to stand up on the right side of history.
All right, let's get more on that now. Bring in Hafidzi Razali, founder and CEO of government advisory firm Strategic Counsel, joining us from Kuala Lumpur this morning. Thanks very much for your time, Hafidzi. I want to start with the tone that was struck by leaders in Malaysia and China following the visit, because it was certainly very positive, a very warm embrace of both sides, and it sort of stood a little bit apart from what we saw after the trip to Vietnam. So what do you make of it? This Malaysia really expressing a lot of sort of admiration for the way China is conducting itself.
For sure. To start off, I would say that the timing and the countries selected to be part of this tour is a strong statement by China itself. Specifically for Malaysia, this is the first time in 12 years of President Xi Jinping coming over. Yesterday alone, we saw multiple MOUs being exchanged, covering various aspects from defense to investments, trade, agriculture, transportation. This is a massive commitment between the two countries. And of course, among the beneficiaries of the projects lined up, part of the MOU were projects related to the Belt and Road Initiative. We are seeing emphasis on the two countries' Twin Parks project, which is revitalized between the eastern coast of Peninsular Malaysia to the southern part of China. We are seeing a commitment to finishing the East Coast Rail Link by 2027. Also, further down south, there's an emphasis on the Johor-Singapore Special Economic Zone, especially with Forest City as a financial hub, which is by itself developed by Chinese developers. So definitely this is a moment of excitement by a lot of Malaysian parties, especially in light of what's happening with the global tariff issues.
Hafidzi, David here. Perfect timing, in fact, as you were just talking there. The joint statement between the two sides, Malaysia and China, have now just been released. And, you know, we're just sorting through the details, but just to give you a sense of what has been said so far, it shouldn't come as any surprise that the two will be expanding economic cooperation, that the statement, in fact, the title of the statement, I believe, is on this shared future. I think, Hafidzi, the question I have then there is, you know, I think China has been the largest trading partner in Malaysia for the better part of the last 2 decades. The U.S. obviously is not far from the top. Does this meeting, this week, though, bring Malaysia closer into the orbit, the economic orbit of China? And does it add more clarity right now to those companies that might find themselves in the middle of this?
Yeah, Malaysia has had a long-standing relationship with China, and with what's happening relating to the U.S., the relationship now is even closer, simply because Malaysia has no choice. China is Malaysia's largest trading partner, as you have rightly pointed out, but it's also involved in the various parts of the day-to-day living and infrastructure development in Malaysia. The unpredictability that we have here makes Malaysia, puts Malaysia in a spot where not only it has to widen relationships, but deepen relationships, especially with its largest trading partner in China. And understandably, as a developing nation, a smallish one on top of that, Malaysia would want to tap into the capital and investments that may come from China, especially with technology transfer, the buying power that China has, and the large market base that will be very useful for Malaysian export markets. Therefore, I feel that this even closer relationship with China now is just to fill in the gaps left by the United States as one of the top trading partners, especially if you're talking in the context of economic integration, as well as in improving regional networks within ASEAN.
We've got some reporting, though, about how the Trump administration is looking to use negotiations as a way to isolate China. given that Malaysia's trading relationship with the US, not as significant as China, but it is still important, how would you be advising the Malaysian government to conduct itself as it goes into talks with the White House?
Well, first, Malaysia would have to diversify its trading partners. This is something that Malaysia has been doing for the past 10 years. And in fact, if you're looking at the data now, only 10% of Malaysian exports is to the US, forming just 6% of our GDP. However, if we look more closely into what we export to the US, 60% of it is semiconductors, which is currently exempted. But of course, we are looking at a situation where such exemption can easily be reversed, as what has happened with pharmaceutical products. Also, we have to bear in mind, beyond the items listed in the exemption list, significant parts of Malaysian exports would include items that are not exempted, such as furniture, rubber products, textiles, as well as machineries. These are important exports from Malaysia to the US. However, what the Malaysian government has to do now is to continue the negotiation with the US trade officials, particularly in emphasizing the narrative that Malaysia is not a back channel to sanction or tariff economies. This is highly important. And what Malaysian government officials are trying to do is to emphasize that we have a goodwill of long-standing relationship between American investments and Malaysia in the past decades. More importantly, however, is that beyond US and China, Malaysia would have to improve its trading capacity, particularly in the context of multilateral trade agreements such as the RCEP, CPTPP, as well as improving its intra-trade ASEAN activities. Those are all important for Malaysia to hedge against the risk.
Yeah, just to get to more lines here coming through out of this statement here, Hafidzi. So on top of the establishment of ties around defense, which I think is interesting and somewhat fresh, there's also an agreement to build stable industry and supply chains. Now, the reason I end on supply chains here is you brought up a good point, and I want to broaden this out to ASEAN as a whole. I mean, there was a reason these three countries were picked, right? Vietnam, Malaysia, and Cambodia. Does it seem like this should be the way that others in ASEAN should be dealing with China? Bilateral? Or does it make sense for ASEAN to put up a more, let's call it, united front? Because certainly as an economic bloc, they are bigger than they are individually.
One thing for sure is that ASEAN is wholly united in dealing with the tariff issues with the US. In fact, ASEAN does not have much options. It can't go against the US by retaliating. And secondly, it doesn't have the leverage that large trading nations like China would have. To respond to your question, ASEAN as a whole would be negotiating with the US, particularly in the context of having an FTA, ASEAN FTA, as what ASEAN has been doing with economic blocs such as the EU. But more specifically, ASEAN member states would also have bilateral negotiations with the US. We are looking at Vietnam doing the same, as Malaysia also trying to do by end of April or early May. But more a longer forward view of this is that ASEAN member states, including Malaysia, they are now looking into growing their economies beyond just providing low import substitutes or a destination for cheap labor. Prime Minister Anwar Ibrahim of Malaysia has mentioned that the emphasis for Malaysia moving forward is to attract investments to fulfill its focus of moving up the value chain and produce value-add output that will be more relevant to advanced economies, such as in meeting the policy objectives of the new industrial master plan, as well as the new energy roadmap transition. So those are all important for ASEAN member states to improve not only its intra-ASEAN trade, but to put in more investments and financing facilities for ASEAN member states to slowly transition into higher economies so that it would continue to be relevant as trading partners to larger blocs beyond just the EU or China and the US particularly.
Yeah, we mentioned today's editorial from the China Daily before we brought you in, Hafidzi, and I think that's interesting because the framing there was China's not asking its neighbors, they say, to pick sides. Now, that seems to be what the U.S. is asking of their allies in the region. You know, you pick a side. That doesn't seem to be what the China spin to this. What does this mean for members in the ASEAN community that currently, and I'll mention the Philippines, for example, which might be finding itself more under the orbit of the U.S. I guess, is this in some way a wake-up call?
Definitely. And we can't separate geopolitics from geoeconomics. At least on the geoeconomic front, ASEAN is now united to overcome the tensions that we have right now. Simply because if you're not affected by high amount of tariffs like Cambodia, Vietnam, you are still going to be affected indirectly from the lower trade activities. Hence, ASEAN will have to be united, especially when it's not in a position to pick sides. It will have to remain neutral. But what it can do now is to just widen, diversify, and deepen its trade relationships so that in worst case scenario, you are hedged against all risks possible. And more importantly, you will have each other to rely on support, especially financial and investments.
Hafidzi, Razali, thank you so much, founder and CEO at Strategic Counsel, joining us today to really unpack what is a very complex, of course, story, geopolitically, geoeconomically, as he was just pointing out there. Okay, breaking news. This should be relevant. It might turn out to be a lot more relevant than we make it out to be currently. So you have the Ministry of Commerce, you have the MIIT, you have the PBOC. What's lacking, though, based on the headline, is the Ministry of Finance. But all that being said, you have a multi-department briefing that looks to be scheduled for Monday. Stay tuned for that. It's worth pointing out, though, that markets in Hong Kong specifically are shut on Monday as well. Yeah, stay tuned for more details on that. Dollar China not really showing much reaction right now. Risk assets are bid, though, in a greater China universe. Plenty more ahead. This is Bloomberg.
Chinese EV maker Xpeng says it's still optimistic about its overseas ambitions, hosting its first global launch with the new X9 minivan in Hong Kong. Founder and CEO He Xiaoping spoke exclusively with Bloomberg about the car maker's localization plans and growing global trade challenges.
对于一家企业来说，我们期望是稳定性。
For a company, we expect stability. In any case, stability will bring political, economic, and cultural certainty. And only then we can formulate a clear corporate strategy. So we deeply believe that stability is above all. In fact, Europe is the focus of Xpeng's globalization strategy, and we will strengthen our business in regions including Southeast Asia, the Middle East, Central America, and South America. However, we still hope that one day, more Chinese companies will be able to expand their businesses into other countries, including North America, under stable policy conditions.
We know that the Chinese and the Europeans have restarted talks about this minimum price mechanism, potentially to replace the tariffs, which can go as high as 45% into the EU. How would that affect your plans for the European market? Potentially, would that mean scaling back on the immediate need to have your own production bases in Europe?
We have noticed this news, but I believe the talks are still in the early stages. For me, the certainty lies in the tariff policies that China and Europe clearly implemented last year. As we Xpeng, we firmly believe that only through localization in areas of localized R&D, service, manufacturing, and sales can we ultimately achieve comprehensive globalization. So we are working on how to better implement our localization strategy in Europe and other regions. In the future, we will announce our localization strategy in certain countries and expect to have more localization strategy in more markets.
Let's talk about chips, because you need these chips across the board, whether it's your flying cars, your humanoid robots, your industrial robots, and of course, self-driving robo-taxis and the like. How critical was it to build these chips in-house, not necessarily rely on the NVIDIA Thor chips and create your own Turing chips? Was this because it's cheaper, or because of export controls, or because you have to meet certain requirements from the Chinese government that more chips in these kind of products need to be made in China?
实际上，像 Tesla、像 Apple 一样，
Actually, companies like Tesla and Apple are developing their own chips, and they're certainly collaborating with NVIDIA and many other chip suppliers. According to our research, each Xpeng vehicle contains 5,500 chips from global suppliers. Given the large number of chips, the reason the Xpeng is working on the in-house chips is that we hope we can leverage our own capabilities. For instance, if we aim to achieve autonomous driving and use global autonomous driving systems, we need chips that can help our autonomous driving perform better in conditions like nighttime and glare. We hope to maximize the performance of the chips, and at this point, there is a huge value of customized chip. So in the future, we believe we will collaborate with many chip suppliers, including NVIDIA, while continuing to focus on developing our own customized AI chips.
There you go. Xpeng CEO He Xpeng speaking exclusively with Stephen Engel there. The global launch, fantastic visuals there. If you are one of our Bloomberg clients, you can check out that interview we just did and played out, and many more that we have played out throughout the course of our programming today. Check it out, TV Go. Scroll back, of course, and be part of the conversation. If you have any questions for us, for our guests, any comments, any suggestions, we welcome them, of course. Plenty more ahead. This is Bloomberg.
So, Dave, do you have a lazy $64 million sitting around?
No, I have a lazy self sitting around. I'm lacking the monetary part to that, which I guess goes into why I am lacking that.
That's why you're missing the $64 million.
But I'm happy. I'm happy. I sleep well most of the time. This week, not so much. I needed a few dormicums. But who hasn't, really? But yes, you're going somewhere with this.
Well, I am going somewhere with this because there's this Hong Kong developer, and it's going to be testing the appetite essentially for luxury properties in the city. So let's get more on that now. Bringing our Asia investing reporter Venus Fung joining us. So Venus, I mean, this is. People need to understand Hong Kong is the most expensive property market in the world, or at least among them. But tell us about these homes and what really could justify the price tag as well.
So yeah, we are seeing this new big-scale 20 new mansion at this peak area at the very prime address called One Plantation Road. So it's like developed by WAF Holding. If you remember, Mount Nicholson is one of their previous projects. They sold like a house at most expensive in Asia per square foot, breaking the records in 2021. So the developer has built a reputation for upscale residency, and this is like they have been marketing to their wealthy clients since last month. So it's now they're going to offer 5 new mansions on the markets later this year, which could fetch $500 million Hong Kong dollars. This is the size and scope we're talking about.
Okay, not chump change. What's special about it?
So yeah, they sit on this very this size. It used to be. It has been a long historical history with the luxury. So it used to be the residence for the Lane Crawford co-founder family. So like more than a century ago, it used to be one of the family residences for the Lane Crawford family.
Okay, that's nice. Read all about that for Bloomberg clients out of Venus Fung here, and what it might actually signal about the. We've had some challenges within the luxury segment of the property market here, so what it might signal, and we'll see if we get buyers here, 500 million Hong Kong dollars a pop based on recent transactions within the area. Speaking of property, and speaking of maybe a way for us to be able to achieve this, casino stocks are coming up on your screens very, very shortly. Property's on the way up. You have, of course, some policy hopes, and the data yesterday did suggest some, again, further signs of stabilization. Macau casino stocks, that's also really on the consumption story. VIP spending, you look at the intake that's coming through, also fairly supportive of what's increasingly connecting the dots, a better story to be told there as far as casino goes. Maybe a plan for you, Bill, on the weekend, hit the slots.
Yeah, just test my luck.
Yeah.
With blackjack or whatever else I could try. I don't know. I haven't been to a casino for years. But anyway, point is, let's just take a quick look at the Hang Seng as we go into the break here today, because there's a couple of things that are standing out. Firstly, we've got more details. There's going to be a major policy address, coordinated policy address on Monday, looking at these ways to try and ramp up the service sector, essentially. And then also front of mind, of course, is negotiations on trade. And we've seen some lines out of Japan this morning. Seems like it's going okay so far.
Peace out.